Unrivaled Nation. Today we're going to talk about June 2021 potential multi-bagger. What company are we looking at? We are looking at JD.com. As you might know, it is one of my largest holdings, and I'm actually thinking about increasing it even more, potentially buying even more. And let's walk through why. This is a video dedicated to understanding this thesis. And so as we look at it, one of the key aspects that originally got me involved with JD, or at least got me interested, was reading the JD.com story, which talks about the founder, Richard Liu, and really about how he took what was selling like CDs, physical CDs in a marketplace, and how he had to pivot to selling online, effectively a bulletin board online during the SARS outbreak in China, because, hey, you couldn't meet in person. There was a pandemic going on in China. And so he noticed that he was able to successfully sell his products because people recognized his name and they trusted his brand. They knew that from shopping with him back when he was running just a couple of stalls, that he sold legitimate goods. He wouldn't always have the cheapest price, but he would sell quality, and you could trust the electronics that he was selling. And so that led to him rapidly growing an online presence because folks said, hey, I know this brand, I know this guy, we can trust it. And so that's sort of where it started, understanding. So he quickly shifted from offline to online. And this video, you need to understand, this is, I would view as almost like part one. Like maybe I'll do JD multi-bagger review in a few months from now. And you can see additional thoughts and that I will fill out in the Discord channel. But what needs to be considered is, here, let me move myself in the center of the camera. What needs to be considered here is that this is a huge thesis with a lot of different moving parts, but in this video, I'm going to be breaking down what I'd argue are the key elements to show you, even if you don't look at all these little aspects to it, the value and their value proposition just strikes me as just obvious, and why I like it and why I own it and why I think the risk reward is extremely compelling. So I'm not going to be able to cover everything in this video. That'll be impossible. There's just a lot of moving parts. And in some respects, it's like, hey, can you do a 20-minute video on Amazon that covers the whole thesis? You wouldn't be able to. Could you do it in an hour? You wouldn't be able to. There's so much. And so that's why here I'm trying to cover what are the big rocks that we need to cover to sort of understand this thesis. And that's what we're going to do here in this video. And so when we look at this, you see this slide pretty much in every one of their presentations, where they're the largest, retailer in China, 114 billion RMB sales. And, they talk about their growth rate, from 2016 to 2020, a 30% CAGR, and saying, hey, look, Amazon.com, that's pretty much, look at the top listed US retailers. Amazon has a comparable growth rate, and yet, what they're not saying is that Amazon trades at 4x revenue, maybe 2.5, maybe 2 to 3 times if you back out their AWS stake, so their cloud services stake, which is still 3x more than JD, because JD doesn't really have the strong cloud platform that Amazon established with AWS. I'd argue Alibaba does, as Alibaba is the top player. As in full disclosure, as you know, I own a stake in Alibaba as well as JD. And this is the key premise. It's everyday low price. I mean, Richard Liu took that straight out of Sam Walton's playbook from Walmart. So he's like, look, let's make this a brand that people trust, and we can build the margin later on. Let's just grab people's mind share, and then as we get scale, then we'll develop this cost advantage from the suppliers. But not everyone's loved this story. A lot of people don't like it, and you could sort of see how this thesis has developed over time. In 2016, and keep in mind, they didn't always have this level of detail. This is a fairly recent development, is they had electronics and home appliances as 70% of their revenue. And so people said, man, this is razor thin margins. They're never going to be profitable off this. And that's part of the reason why it's traded at this valuation. And I think what you're going to see here as I review these numbers, you're going to say, oh, this thesis needs to be updated but there's this lingering thought process of, oh, this is just a Chinese tech company that's never going to be profitable. Let's actually see what's going on, because here it is. General merchandise has gone from 22% to 33% of their business, has increased by 4x in 4 years, from 58 billion RMB to 250 billion RMB. So this is super important in terms of understanding the thesis, because this means you can have higher margins, because the electronics and home appliances space, yes, it is lower margin. It does cost more to fulfill. But if you start looking at things like maybe apparel or cosmetics or luxury goods, you can be looking at much higher margins long term. And customers, what's interesting is seeing this growth in general merchandise and seeing their growth in active users now, is given that Alibaba has effectively 900 million plus users across their platforms in China, there's a good chance customers have tried Alibaba's Tmall or Taobao, and now they want a premium experience. They want an experience where they know they're getting the goods they want. They know they're getting a very fair or very good price. And that's part of the reason why this general merchandise line is increased so significantly. And another aspect, this whole fine that Alibaba's had to pay, this actually is to their advantage, because what Alibaba had to pay a fine about was they were telling suppliers to say, hey, you have to pick which platform you want to be on, either JD or us. Now now that Alibaba's been fined, it should be even easier for JD to get more and more general merchandise on their platform and to be able to continue to put up exceptional growth. I mean, look, 4x in 4 years for their general merchandise. And then if you look at their marketplace and marketing revenues, that's gone up by 3x in 4 years. So this is also a hyper growth segment. And it's worthwhile to take a little second to understand this business model. Historically, JD was entirely 1P sales. So it's effectively one platform. They're buying the inventory and then they're selling it to you at a small markup. And it was razor thin and a tough business model. And the appeal of Alibaba, and part of the reason why it has a much bigger market cap, is because their business model was always focused on marketplaces. And marketplaces are very, very profitable because you're not taking the inventory risk. What you're doing is you're getting a very lucrative cut that's almost pure margin every time there's a transaction. And you want to advertise your spot in the marketplace? Boom, you can advertise, and that's also going to be super high margin. So JD started off with saying, hey, we're not going to do that model. Now they're saying, hey, we're primarily our own inventory, this 1P model, but we are including this marketplace segment, and that's what I'm calling out here, which is their marketplace and marketing revenues has grown significantly as well. And this also is going to be a super high margin. This will be much higher margin than general merchandise revenue. So general merchandise revenue will help their margins. Marketplace and marketing revenue certainly will help it. But one recognizes that they also have other business lines that are going to hurt their margins or have hurt their margins recently, such as the hyperscaling logistics segment. But we'll talk about that in a minute. And so looking at logistics, I mean, logistics has hyperscaled. It has gone by 12x in the last 4 years. I mean, it's simply incredible what they've done. Now, logistics is a majority-owned subsidiary that provides best-in-world logistics solutions, and we'll talk more about that shortly. So to understand this value in terms of thinking about how are you supposed to consider all these different pieces like electronics or general merchandise revenues, marketplace logistics, you actually have to peel back the layers, particularly on the general merchandise revenues. Like, why has general merchandising grown so fast? Why has logistics grown so fast? And so when we start peeling back the layers, one reason why general merchandise has grown so quickly is a majority-owned subsidiary called JD Health, which recently IPO'd, and they've become the #1 online pharmacy in China. And that reason why, how can you scale up so quickly for a business that's only been launched in the last decade, become this huge pharmacy? Well, it's part of this halo of being trusted. This JD brand is trusted. Okay, so now you can sell pharmaceutical goods. And this is honestly one of the best telemedicine models I've seen, as it's effectively a one-stop shop. You have the telemedicine or the consult, then you're selling the pharmaceutical products. And keep in mind, they've learned their lessons. So they do first party sales, so it's inventory they own, as well as marketplace. Now it gets a little tricky here because you want to make sure you're not selling, particularly with pharmaceutical related goods, it needs to be a trusted supplier. But this, once again, this is the importance. Being trusted is so critical. And then lastly, they're going to leverage their logistics and retail footprint, because this is something I'm not even going to be able to do a deep dive on this aspect, but this is going not only from e-commerce but to omni-channel. So that way you could also pick things up across, the stores that they're investing in and building out a physical retail presence. Maybe I'll save that additional color in a post in the Discord channel on JD, because we're going to have an exclusive JD channel in Discord. And so this is an exceptional business model, and you could see the growth that they've achieved, where they've gotten hyper growth. Now, part of that was due to an acceleration from COVID, 70 to 80% growth. Before that, 30 to 40% growth. It's more lucrative than their traditional, home appliances and electronics business. You can see it has 25% plus gross margin versus less than 15% on a consolidated basis. And the segment's already profitable. It's already at 3 to 4% profit margins. Now, some of this includes stock-based compensation, but I suspect they could be much, much higher margins in the future, especially given their 25% gross margin. So this is really interesting, and this is a majority-owned segment that recently IPO'd, selling a few percentage of the company to the public. And this is another benefit of being trusted. This is part of the key theme of this video, is that, hey, you can do so much more and take share when you are a trusted brand. Like, they recently opened up their first baby and maternal store. Hey, selling products when you're breastfeeding, selling home care products, you want to make sure it's legitimate. You want to make sure you're not poisoning yourself or your baby. This is super. This is part of the JD halo that they will benefit from in terms of rolling out a, hey, first baby and maternal store. Oh, what about luxury brands? Louis Vuitton recently partnered with JD, launching in their store. This is another example of being an advantage of being trusted. I think one of my favorite quotes from Charlie Munger is how he talks about how wonderful it is to be trusted. Like, it's something that needs to be earned. And I love that mentality, especially as I think about JDs. It's something that I think they focus on earning every day. It's part of their business model. And look, another aspect of this halo is they recently launched in the last few years a separate, and keep in mind, this would also be under their general merchandise. So general merchandise is a broad umbrella, but they've also launched industrial maintenance and repair and operations for products and services. So think about this, the nuts and bolts for industrial products, where you got to make sure, hey, these are legitimate products. You don't want a machine to get broken because some industrial products, you got an illegitimate product that actually is going to break your whole machine. And this is just a perfect example of what you see with JD, because there are a few key nuggets that are worth the vast majority of JD, as you'll see. But there's all these one-off little things where it adds up. Like, it's like, yeah, this couple $1 billion here, a couple $1 billion valuation there, that when you see my valuation at the end, you're going to be like, wow, there's so much here. And there's largely, you'll think, wow, there's, at least this is the way I'm considering it, is that there's a lot of pieces that I'm not even including that still makes the valuation very compelling. And so here it is. Just, they recently did a financing for doing a Series A for this JD MRO, maintenance, repair, operations business line. They still own majority of the stock, over 80%, but it's worth effectively $1.7 billion when they did that raise. Probably worth more now. And so it's a lot more than just retail. You have their retail segment, you have logistics, which we'll talk about in a second, and you have several new business lines like community purchase business model, JD Digits, which includes JD Cloud. You have JD Property. There's so much going on here, and like understanding logistics, for example. Logistics, this is a best in world logistics operation with 90% of orders same or next day delivery, pretty much across China. Almost all counties and districts in China. Keep in mind, China has a lot of different geography, a very big population. So this is a big deal, being able to have this type of warehouse network, this type of fulfillment center network. And this is the part that reminded me of Amazon, where they're turning a cost center into a revenue driver. And they've, over time, the revenue in JD Logistics has slowly, and I think in 2021 it'll be the year where the vast majority of, or the majority of JD Logistics will actually be from outside partners. So historically it's primarily been JD because they needed it for their business. But they said, hey, this could be a revenue driver if other merchants, other e-commerce platforms wanted premium delivery options. And it costs a lot. It takes a lot of time to build it out. Here it is. We've already done it. And so this is going to be an offering that's already rolled out to thousands of merchants across China. And it's going to become a greater and greater revenue driver. Currently, it's about 50-50. I suspect 2021 is when the majority is from other parties. Okay, so how can logistics, like something where you're just delivering a product, be an example of something that's unrivaled? And I hope you've sort of started getting this theme of why JD could be unrivaled based on that sort of halo, based on that brand perception of getting quality goods at a fair price and a growing middle class in China, how they would want to buy that from a platform they trust. And you see that with the growth in general merchandise, clearly taking market share. And so how could logistics possibly have an advantage, possibly be unrivaled? And you look at this picture and there's so much going on here, because you keep in mind, part of their same day or next day delivery includes refrigerators, cold chain delivery. You want some fresh crabs, you can get that. Let's say high touch deliveries. You want to get some sort of Louis Vuitton delivery or some fancy jewelry. You can literally get this, the white glove treatment. There are autonomous drones that routinely deliver in remote areas in China. This is not just a pie in the sky concept. There's videos of this. They also have fully automated warehouses where it's something like 4 people and something like 100,000 packages being, set up in a day. Now, these are critical differentiators as companies, merchants think about, hey, how do I want to get my goods across China? If you're looking at a Chinese, the whole Chinese market, and thinking about how do I want to get my goods there and how do I want to trust that it gets there in a reliable way, JD's logistics operations will do it. And I didn't even put a post here on this, but in their filing on JD Logistics, they talk about how, looking at the Chinese post office, they categorize how many criticisms or complaints different logistics centers get, and JD Logistics is like 10 to 100x better than the other players out there in terms of the number of complaints. And yet they have, it's a huge market. They're the number one player, but it's still less than 3% market share. And they're rapidly taking share. See, this is the part that gets me excited. When I see a big market like what they're talking about, which is all these different types of deliveries, and they're rapidly taking share, this is reinforcing the idea, okay, you're doing something special. This is world-class operations, no question about it. And there's a lot more to looking at JD, beyond logistics. They have their community purchasing option, which is to try to compete with Pinduoduo in lower tier cities. They have JD Cloud, which in itself is worth several $billions, which they've consolidated into a segment called JD Digits, where they own 42%. There's JD Property, which is their infrastructure asset management and integrated service platform, which owns, develops, and manages our logistics facilities and other real estate properties, i.e. they manage the real estate properties. JD Logistics pays them, but they own the underlying properties. It's effectively a property management firm, an asset management firm. Once again, worth several billion dollars. And how are you supposed to think about valuation? So I wanted to spend some time not only talking about why I think JD is an exceptional company and has different angles where it's potentially unrivaled, but I also wanted to make a strong case on why I think the valuation is just so compelling. And so let's go through a few of these pieces. So JD Health, 6618 on the Hong Kong Exchange. This is their current price, most recent price. This currently has the stake that JD owns is currently worth based on its market price. So this isn't my assumptions for what it could be in the future. Is $30 billion. $30 billion versus JD's current market cap of around $115 billion. So you're talking 20 to 30% here, just JD Health. Then you look at JD Logistics, 2618 on Hong Kong Exchange. Once again, recent price, publicly traded, another $20 billion valuation that goes to the market cap. So between health and logistics, which are publicly traded, the share that JD owns represents 45% of the market cap. So then you go, oh, okay, well, wait a second. These two subsidiaries, these two majority-owned segments, they're actually sort of a sideshow relative to JD Core's retail business. And looking at it, you have to back out health because health has historically been included in retail. And think about, well, what could their margins be long term? Somewhere between 4.5% to 6.5% is what I'm showing here. Honestly, there's room for this to be much higher, as management expects it to be high single digits in the future, potentially even low teens. And one could expect this. One could underwrite this, I think, comfortably, recognizing that ad revenue is increasingly a bigger part of the pie, their marketplace revenue, as well as general merchandise, which is higher margin. So then, slap on a 15% tax rate and somewhere between a 15 to 20 times multiple. Keep in mind, this business, excluding their hypergrowth health revenue, that's part of this, grew 26% last year. So 15 to 20 times for a business that's growing over 20%. Values this at around somewhere between 400 billion RMB and 800 billion RMB, or about 60 billion US dollars, 120 billion US dollars. So this segment alone, their core retail business, giving no credit to any future growth, is 50% of their market cap up to 100% of their market cap, giving no credit to the future growth or the subsidiaries I just talked about. So this core segment, you could say, oh, if you just say that the high side is applicable and you throw in the other two segments, that's automatically you're looking at 50% upside. So, but keep looking, keep understanding that there's actually a lot more here that makes the thesis so compelling in my mind. Well, wait a second, is it really realistic that they deliver on these margins? And look, they're already at this level. And it's been improving over time as they've improved their share of general merchandise and marketplace revenue and the ad revenue. And they think they'll continue to increase their profitability from greater scale, i.e. suppliers give them better economics, and faster growing advertising service, which I already talked about, the marketplace. So this might prove to actually be conservative. Even this 6.5%, maybe it's 8, maybe it's 10% in the future. To put this in context, you look at Alibaba's historic economics, which is primarily driven off a marketplace business model, and it was something like 40% margins. So you can understand how lucrative getting marketplace business can be and why there's a lot of optionality here with this thesis. So then, so let's do a sum of the parts based on what we've covered so far. So JD Health, current market value. JD Logistics, current market value. This assumes the price stays the same. No change in growth, no discount. This is just where it's at today. Here's this range of JD Core, which I just talked about, but gives no credit to future growth. Then there's also cash on their balance sheet. They have a sizable cash balance worth around 120 billion RMB. But that doesn't even include another about 100 billion RMB in equity investments and investment securities that they've made. And it's across several different things like Dada, several different companies. I'm not going to get into it here, but it just shows you. I'm not even going to throw in that 100 billion RMB here to show you this valuation. Not including that, you can still get a compelling valuation. So here it is. No credit to their cloud business, their AI segment, their property segment. their community buying business, their international ops, which arguably add several billion dollars, many billion RMB to this valuation, not even including this. So I think we're looking at a draconian assumption that looking at adding this up, you get minimum 14% upside, 63% upside on the high side. And keep in mind, this gives no growth, no cash accrual for this business model. You don't get any sort of free cash flow benefit, no investments, no 100 billion RMB investments that I'm talking about. This is, in my opinion, this strikes me as extremely draconian, where I'm saying, look, based on super conservative figures, in my opinion, there's at least upside from here. At least somewhere between, let's say, 20% and 60% upside, based on super draconian figures. Okay, but now let's actually start thinking about what could JD be worth in the future. And when you consider what JD core business could be worth in the future, and once again, you're using the same margin profile, that 4.5% to 6.5%, but you think, hey, this could grow over time, maybe 14 to 18% annualized growth in the ensuing years. Well, hey, now you're looking at a much better valuation. So this is once again low to high. And then in that case, assuming 14% growth, keep in mind, their JD core business grew 26% last year. So 14% annualized over the next 5 years. Then in that scenario, once again, still not giving credit for their investments, giving no credit to a change in value in health and logistics, effectively saying health and logistics, their stock price is going nowhere over the next 5 years. Then in that case, you have 63% upside and effectively 200% upside. This still is missing out on what type of cash is going to flow to shareholders, or at least accrue to the balance sheet. And I'm penciling out 2.5% to 4.5%. Now this will affect your return based on what does management do with it. In my opinion, this 63% upside to 200% upside strikes me as still pretty conservative, still pretty reasonable based on this 14 to 18% growth. I'm trying to be very reasonable with this JD core segment in terms of what they could do over time. And I'm not including a lot of assets. They're equity investments or several subsidiaries that have been valued at several billion dollars. And so thinking about this cash flow, this 2.5% to 4.5% that I effectively add to this hypothetical annualized return, then you go, well, wait a second, are you actually getting cash flow? Is this business cash flowing? And you look at what they've historically done. In the last 12 months, ended March 2021 or March 2020, 15 billion RMB versus 28 billion RMB versus a 740 billion market cap. So that's effectively a 2 to 4% yield that shareholders are getting, where cash is accruing to the advantage of shareholders. So now the next question is, well, wait a second, isn't this one of these complex Chinese entities where you're not actually going to benefit? There's no cash actually that's going to accrue. Well, actually, this is the part where it starts seeing even more interesting. Or in the most recent conference call, they called out, oh yeah, by the way, we repurchased $800 million year to date of stock, 10 million ADS. So they're buying the US shares. So they're starting to return capital. So thinking about this cash accrual, this actually could be even better based on this, what I think is buying back shares at a very reasonable valuation. I think management does too, because they're effectively buying it at the mid 70s price based on the 800 million year to date and the 10 million ADS. Now, let's do a quick back of the envelope, simple back of the envelope calculation for thinking about growth, cash accrual valuation. This is sort of like a reality gut check for thinking about, well, what could my returns be long term? And so I always like to break it down into its simplest elements to think about what your returns could be. And in investing, there's only 3 buckets that drive your return. There's underlying fundamental growth. There's cash flow that might flow to you as dividends, buybacks, or some sort of distributing an asset. Or there's a change in valuation. So we're thinking about these 3 components. And so looking at JD Core, you have several hyper growth segments. Maybe, let's be conservative, maybe their growth is somewhere between, let's say, low teens and high teens over the ensuing 5 years. Okay, so at a minimum, you're thinking your returns is going to be in the teens somewhere. Then next up, layer in whatever your cash flow that I already talked about that they clearly are generating, that's accruing to you as a shareholder, whether or not it's building up on the balance sheet or they're buying back stock. If it's buying back stock at a good valuation, that's even better. It sort of accentuates the returns over time. It juices the returns. But let's not give credit to buyback. Let's just assume it accrues on the balance sheet. If that's the case, once again, I already penciled out 2 to 4%. So let's say you started off at 12% growth, which is below the assumptions I started with, I shared earlier. 12%, layer on, let's say, another 2 to 4% growth. Okay, so now you're talking about high teens type of growth at a minimum. And then the last component is, well, wait a second, what's the valuation? And I think everything from this video should convey the point that I believe the valuation is actually quite compelling, and that the valuation, if anything, could expand. So if you have a situation where the valuation expands and they deliver on this growth and they buy back stock, then I think that 200% upside goes even more. Maybe you're looking at 300% or more. And so that's the reason why I think this is so compelling, is I'm looking at like, well, wait a second. In my low case, just thinking about like low teens growth, low single digit cash flow that's going to be accruing to you as a shareholder, if there's no valuation further discounting from here, valuation just stays flat, then I'm thinking 50 to 100% upside. And that's the reason why it's one of my top positions, and why on the high side, I think this is a multi-bagger from here. Even though it's already been a multi-bagger for my investments, it will continue to be. So I hope this take on JD, sort of a deeper dive, has been helpful to you. There's a lot more to the thesis here, like a thesis on their omni-channel investments and getting, physical retail investments, locations. There's going into details on their individual equity investments, their relationship with Tencent. So if you have particular questions, I'm happy to do like Q&A and build that out in the Discord channel. I wanted to make a video here to sort of capture why I think JD, should be called out as the June 2021 potential multi-bagger. So I hope this video has been helpful for you, and I'm grateful to be on this journey with you. Thanks so much.